Sup, freaks? This episode was brought to you by our good friends at River. The last few months have shown us that it's really hard to find a reliable partner in the Bitcoin space that can get you access to Bitcoin, help you purchase Bitcoin, help you mine Bitcoin, and help you send that Bitcoin to cold storage. Third-party dependencies like Prime Trust are security holes. Luckily, with River, they built their whole exchange. They built their infrastructure. They built their wallets. They built their multi-sig cold storage. Their Bitcoin that is held on their exchange is backed one-to-one in that multi-sig cold storage, though they do encourage you to take self-custody of your Bitcoin. If you DCA, if you dollar cost average, you're not going to pay any fees on those buys. Other exchanges have insane fees and spreads on DCA purchases. You can avoid that using River. Go to river.com/TFTC, set up that account today, and pick your last Bitcoin partner, the most reliable one. River.com/TFTC. Enjoy this episode. We're rolling. Rolling. Keep those lots rolling. We're back with the Atomic Finance team. Well, now the whole team. Matthew, you've been on the show before. Tony, I believe this is your first time.
First time on the pod. Long time listener.
First time, long time. I'm very excited for this discussion. We met up in Miami a couple of months ago now at this point to catch up on what you guys have been working on at Atomic Finance. And I thought it was funny because you guys did pitch day and you got booed for saying the word yield. Is this true?
Yeah, that's true. Well, I started off with asking everybody what they thought of, when I say 8% APY, what do you think of? And everyone in the audience yelled scam, which was perfect. So, but we'll get into, there's different types of yield out there. Some types are better than others.
Yes. As we've come to find in this market over the years. But before we jump into what you guys are building at Atomic and what you've been iterating on over the last couple of years, Matthew, it's been what, like 1.5, 2 years since you've been on the show. So why don't we start just giving the freaks a refresher about what Atomic Finance is, how it works, why you guys founded it, what your backgrounds are, to level set the conversation.
Yeah, absolutely. Maybe I'll start with, I know I talked about this previously, but I think it was 2.5 years now. But I'll start with like maybe where we got into Bitcoin, how we met each other. I actually originally got into it back in 2014. It was my dad that introduced me to Bitcoin, and he's a bit of a gold bug. And so something like Bitcoin was really interesting to him because obviously it's outside of government purview, just like gold. And so back in the day, I was just I was in high school. I was just managing his Bitcoin for him, and I kind of forgot about it for a couple years. Fast forward 3 years later, I was at the University of Waterloo, and I meet this guy here, Tony. He was my roommate, and basically I wouldn't shut up about Bitcoin to him.
Oh yeah, I mean, you're quite the persistent guy in terms of trying to show me Bitcoin. But there was just a span of 3 weeks, I remember, where first week you were like, "Hey, Tony, there's this Bitcoin thing. It went from 1,000 to 7,000 in the last couple of months. Maybe you should check it out." I was like, I don't know. Like, it sounds kind of scammy. I heard about the Silk Road thing, not so sure about it. And then second week, I remember you changed tactics on me. You were like, "Hey, you might want to get into this earlier rather than later. There's this kind of fork that's happening, the SegWit 2x thing." This was back in 2017. And then I remember you were like, "Hey, if you buy Bitcoin now, it's a buy one, get one free. You get two kinds of Bitcoin afterwards." I was like, "Okay, that sounds kind of weird." And then third week, Matt was like, "Hey, there's also this thing called Ethereum, and you can start using it to write smart contracts. You can, run code on it, and then you can kind of start coding on it just with knowing like JavaScript, right? And then start building decentralized Uber, decentralized apps, decentralized everything." And I was like, well, I was like this 20-year-old computer science kid, didn't know much. I was like, "Hey, that sounds kind of interesting." And that was how I actually fell down the rabbit hole, buy my first little bit of first little bit of Bitcoin. And then fast forward a couple of years, by that point, I think both of us We had aped into numerous shit coins, got wrecked at that point. I had worked at a traditional finance insurance company. Then we both went to work at this Ethereum company called Consensus. And we even started working on a DeFi project of our own. In our defense, I guess it had a bit of a Bitcoin twist to it, but all in all, it was quite shitcoiny. It was cross-chain. There was lots of ETH smart contracts involved. And I would say, like, for both of us, our come to Bitcoin moment did not really happen until summer of 2020. That was like the whole DeFi summer thing. You know, if you were in any way associated with ETH DeFi, you got to launch a token. You got to set up yield farming and use that to, you know, bring in liquidity. You got to hype up the token as much as possible. That was the only way to stay in the game when it came to ETH DeFi. And for us, it was like, you know, I don't know, like, I don't feel so comfortable with this whole thing. Isn't the whole point of Bitcoin to just stop the money printing? Why are all these guys like just getting up and printing out a token and doing these pump and dump type things? You know, it didn't seem right. And around that time, that was also when I personally started reading the Bitcoin Standard at that point, finally, and then really started understanding money, started understanding how, hey, you know, Bitcoin isn't this just stock-like investment where you're waiting for it to pump and then you're going to sell it for fiat. It's something fundamentally different. You know, it's this new monetary system. It's a more sound money. It's, you know, a money where folks can actually have full transparency. Everything's verifiable, and, you know, we can control it and secure it without the need for a bank or a custodian. And of course, you know, other aspects of it was that, hey, Bitcoin, you know, there's a true supply cap. There's no, you know, figureheads or anything like that. It's truly unique amongst all the different cryptos out there. And so at that moment, I remember pretty vividly, I was like sitting in my chair in our office. I was like staring at the ceiling. I was like, holy crap, like, what have we been doing? You know, what the hell have we been doing the past few months? Building on ETH, doing this cross-chain stuff. You know, I got up, I called Matt. I was like, hey, Matt, you know, I think if we're going to build Bitcoin financial tools, we've got to build it on Bitcoin. You know, if we're going to build non-custodial sound finance, we've got to build it on the soundest money out there, right? And so that was kind of how we both kind of started going Bitcoin only at that point, and what kind of led us to the current incarnation of what we're building at Atomic. And in terms of what we're doing at Atomic, well, basically, Atomic Finance is a mobile app where Bitcoiners can earn a yield on their Bitcoin while holding onto their keys. We never take custody. There's no BS, you know, rehypothecation, and users have full transparency all the way through. And before I kind of dive deeper into, I guess, how that's possible, maybe take a step back to talk about, you know, kind of longer term vision, why we felt it was important to do what we're building. You know, longer term, what we really want to do here is make Atomic Finance the one-stop shop for non-custodial sound finance for Bitcoiners around the world. You know, sound finance for sound money. What does that mean? Well, for us, it means building financial tools that are self-sovereign, transparent, and verifiable. And whether that's earning a return, taking out, you know, a line of credit backed by Bitcoin, hedging price downside in a bull market, be able to do all that stuff and still hold your keys, where, you know, your risks are fully transparent and you have private and secure control over what happens with your own money. And ultimately, kind of like the way that we arrived at that was we just asked ourselves, hey, what can we build in Bitcoin that we would personally actually desperately want to see exist? You know, what would we actually use our own Bitcoin with, right? And after being in the Bitcoin space for a bit, one thing was immediately clear, and it was that, hey, these current Bitcoin financial tools, they suck. They suck a lot, you know? And after last year, I think a lot of us in the Bitcoin space have kind of learned that hard lesson. You know, if you want to do anything beyond self-custodying your coins, say you're interested in taking out a loan or earning a yield with BlockFi or Celsius, you're handing over custody. And the moment you give up that custody of your coins, the moment you quote unquote lend to them, you're just a number, that's just a number on the screen, right? You no longer own that Bitcoin. You don't have any control over it at that point, and it's just a promise. It's just an IOU to pay you back, and you're opening up yourself to lots of counterparty risk. It's a complete black box as to, you know, what they go and do with your coins after that. And it turns out that a lot of them were just random bets, right? Like with Celsius, they were doing ETH staking, Terra Luna with BlockFi. It turns out that they lent some of their customers' funds to FTX. I mean, we still don't even know like the whole picture, right? And it's just a black box, layers and layers of unknown risk. And we kind of want to take a different approach, right? We want to build robust and easy to use non-custodial alternatives, because until non-custodial alternatives come, these guys are going to keep popping up. They might be a different name, might be a different founder, but custodial financial tools are going to keep popping up until we do something different. And so that's kind of why we're doing what we're doing.
Hell yeah. And before we dive into the dynamics of the discrete log contract and how you guys are providing your end users with yield, which has become a dirty word, but freaks, do bear with us. I do think the way that the Atomic team is set up, their DLC is very interesting in terms of allowing Bitcoiners to make some more Bitcoin on their Bitcoin if they're willing to lock it up. But before we get into that, I mean, you mentioned like DeFi Summer and all these token projects were spinning up and doing cross-chain sort of bridges to commingle collateral to provide these DeFi products that were promising crazy APYs. Before we move into discrete log contracts and the products you guys are building, I think it's important for the listeners out there who have heard about these complex DeFi chains and the bridging and the cross-chain compatibility to understand what in your mind doesn't work there. Like, why don't you think that works in the long term?
Yeah, that's a really good point, Marty. I think for that, there's multiple aspects. There's the Ethereum ecosystem and why there's challenges with Ethereum, and then there's the whole cross chain. So on the Ethereum bit, you've got these smart contracts that exist, right? And everyone's heard about, $80 million hacked here, 100 million, hacked from this DeFi application. And it's really because if you think of a smart contract on Ethereum, there's a really large surface area of attack, right? You're writing all of this, Solidity code with all of these different functions in it, and you never know what the end state is. So you might have a multi-sig admin that's able to change kind of the parameters of it, that they're upgrading the smart contract. And you don't know what type of hacker is going to come in there. And lastly, the other thing is everyone's pulling their money into one place, which is really concerning. And then on the other hand, you try to have these, all these cross-chain solutions that are, trying to provide a way to, build between all these different chains. But the problem is, how are you achieving that? At the end of the day, it's really custody with extra steps. They like to say it's multi-party computation, but who are the parties that are custodying it at the end of the day? So I think it's really just a challenging environment to work in. Whereas if you look at something like Bitcoin or building on Bitcoin, generally the surface area of attack is much smaller.
Yeah, then you combine like the fact that with all these tokens, they have varying liquidity profiles, and it just creates this extremely high risk environment where if you're using multiple forms of collateral within these contracts and one of the tokens is highly illiquid, it creates very precarious situations if somebody decides to dump the coin for some reason or another, which, I mean, obviously Terra is probably the most popular example of that over the last few years, where that is how they met their demise ultimately.
Yeah. Do you hear about the project where the... Oh, I was just gonna say, you hear about the project where the founder had he had 40% of the tokens and as collateral basically in a DeFi loan, which is just craziness. But yeah, sorry, Tony, you were gonna say.
I was just gonna say the other issue with the whole yield farming thing in terms of giving you tokens to kind of incentivize usage is that there ended up being a bunch of these basically whales in the ETH DeFi space that were really just mercenaries, right? They're like, they just, move their coins around to these different DeFi protocols, depending on which was giving the best, yield farming incentive. And for these projects, like, there was no way really for these builders to kind of tell whether they actually had product market fit or not, like whether or not what they were building was actually meaningful or useful beyond, the free yield farming that they provided to these kind of mercenaries. And so that was, as a builder, that's also another kind of major issue that I think the ETH DeFi guys run up against.
Yeah, it's a bit cock and nanny, very complex. And then a lot of the ones that become what they would deem very successful have essentially fallen back to centralized stablecoins driving the collateral, which really makes it interesting to market yourself as DeFi when a lot of the smart contracts that are powering your platform are wholly dependent on a fully centralized stablecoin that can be regulated out of existence at the snap of a finger.
Yeah, 100%. I think like something like MakerDAO is a good example of that, where at one point they had 70% of DAI was backed by USDC. And, and then you have situations that occur where something like Silicon Valley Bank goes down and now USDC is depegged, it's 90 cents on the dollar. And so, I mean, really what, there's a lot of nonsense, I think, in DeFi that exists. And, most of these like financial applications that you want to build in Bitcoin, or that you want to build in general, really can be built using very simple primitives directly on Bitcoin itself without kind of all the nonsense.
Yeah, and that's a great segue into like the point that I think everybody should take from the chaos within the Ethereum DeFi world is you need to eliminate like touch points and points of failure within your model. And the best way to do that is just to wholly encapsulate your products with one currency, which is what you guys are doing at Atomic, leveraging DLCs to create these financial products for Bitcoiners using Bitcoin natively. So I guess using that as a jumping off point, we've talked about discrete log contracts many times on this show, but the show's grown. We have a lot of new listeners out there who may not be aware of what a discrete log contract, which we will be referring to as a DLC throughout the conversation for anybody listening. What are they and how are you guys leveraging them?
Yeah, that's a great question. So I think, so what is a DLC? A DLC is really it's just a simple Oracle contract on top of Bitcoin. So imagine you and your friend want to enter into a bet, for example. Maybe you want to bet on the Super Bowl. How would you do that today? Maybe you and your friend would just be sitting there and you say, hey, I bet 1 Bitcoin on this team. And your other friend says, oh, I'll bet 1 Bitcoin on the other team. And then it comes time to pay up and your friend doesn't have the money. Okay, well, you can solve that by having a third party that maybe custodies that Bitcoin for you and says, hey, I'll custody it for you and I'll give all the Bitcoin to the winner. But what happens if your friend's a little shady and they don't actually end up paying out the money and they run away with the Bitcoin? Well, that's not great either. And so what something like a DLC allows is it gives a way for essentially for you to lock your Bitcoin into a contract where rather than your friend having to take custody of it, you and the counterparty and the other party have shared custody of it, and there's an oracle, an external party that can report on the event that happened, an oracle that basically announces what occurred, and that can allow for either party to get access to the funds that they were due in part of the bet. And so it solves the problem of custody. It solves the problem of counterparty risk. And these simple contracts can actually be used for much more than just betting. You can use it for bets. You can use it for futures contracts. You can use it for options contracts. A lot of the different financial instruments that you really need for Bitcoin can all be built using one of these simple contracts. And one of the great things about it is that the on-chain footprint of it is really tiny. On-chain, it just looks like a 2 of 2 multisig. And so, from a privacy perspective, it's really nice too. So
yeah, it's, again, just encapsulating it within a Bitcoin transaction, essentially, because that's essentially what a DLC is you create a special conditional transaction, which is like, hey, I'm going to put my Bitcoin up here. The counterparty is going to put their Bitcoin up as well. Here are the conditions that would release the Bitcoin to one address or another. And to determine where that Bitcoin ends up, you pull a hash from the oracle that basically determines, all right, if the Bears win today, send the Bitcoin to this address. The person made the bet on the Bears. If the Eagles win, send it to the address of the person who made the bet on the Eagles. It's really fascinating. And like Matthew said, you can build more complex products on top of this, which is what you guys are doing at Atomic with your passive strategy, which is, I guess, the first product out the door, many to come. And so diving into that, what are you guys giving your customers access to in terms of leveraging DLCs to allow individuals to get a return on Bitcoin? We'll use return instead of yield.
Mm-hmm. Yeah. So the first thing that we thought about was like, okay, so like, is there a way for folks to be able to kind of use DLCs in a way to earn a passive return on a portion of their Bitcoin stack, right? Without giving up custody to a third party. And basically, like, the way that we kind of thought about it is that, okay, well, DLCs can be used to represent things like futures and options, but the key is, who are the folks that we're targeting early on? Like long-term Bitcoin holders that don't want to be staring at like monitors all day long, trading and all day long. And so basically that's kind of where we got the idea of turning these DLCs into what we call passive strategies. And the first passive strategy that we wrote out a few months back is the covered call passive strategy, where basically you earn a return or a premium in exchange for selling a call option. It's not completely risk-free. There's a possibility of losing some upside if Bitcoin rips up in a very short period of time. But the difference from BlockFi or CeFi is that you're not risking your whole stack to earn and collect a couple percent, right? But the cover call, there's no possibility of being rugged to zero and wiped out to zero on your stack. There's no leverage, there's no margin call. With a cover call position, there's only two outcomes, right? You either get more Bitcoin or you increase the USD value of your stack. There's no outcome where you don't add to your stack or get more USD. So it's conservative in that way. But at the same time, when we were kind of like testing it out with Bitcoiners, one of the things that we heard was that, I don't know, like it still sounds a bit, it sounds conservative, but like it still sounds like trading, right? I don't have time or the temperament to stare at monitors and kind of keep tabs on the market, right? And so to make the experience as passive as possible, we were like, okay, how can we build an experience where folks can get started? You don't need to know the ins and outs of trading or keep tabs on the market all day and earn a return for the long term. And the way that we did that was the passive strategy aspect. So use some stats, statistics, and back testing, look at market data going all the way back to 2011, 2012, and use that data to kind of identify points in the market where statistically speaking, it's most likely to be a downtrend or a sideways trend for Bitcoin. And that's when the strategy enters a covered call. All that is fully automated by the strategy. No need to keep tabs on the market, and folks can get started in minutes. And while it's not completely risk-free, you know exactly what's going on, the risk that you're taking, and that the strategy is backed by historical data.
Yeah, let's dive into that too, because the strategy is looking to identify price points at which there's a statistical probability using back testing to predict when the price of Bitcoin will go down or stay flat. Two questions. How much value is at risk at any given point in time? Another way to say that is like, what is the downside risk per cycle for an individual using atomic finance? And then two, how do you guys think about like the idea of hyper Bitcoinization and the point at which like the back tested data may not compute with how the market's reacting to Bitcoin's relative scarcity and the attention around the network. Like essentially the point at which people have the light bulb go up and go, oh crap, I need a ton of Bitcoin.
Yeah, I think the way to think about, like the way that we think about it is that the covered call strategy is a way to be able to kind of monetize Bitcoin's volatility. At first glance, a lot of folks hear about covered calls, they're like, oh, that sounds like betting against Bitcoin, right? But the reality is, Bitcoin doesn't go up in a straight line. All right, there's a lot of kind of downtrends and sideways trends that happen, over the course of time, and these kinds of strategies are an interesting way to be able to kind of capitalize on market inefficiencies, to capitalize on sideways trends and downtrends. And so, moving forward, I think covered calls are just one kind of strategy. There's different ways to monetize volatility too, but covered calls are one of the more conservative ways of doing it because you are, you're still kind of like either growing your Bitcoin stack or basically like increasing the value increasing USD value of your Bitcoin. And basically, like in the context of any particular covered call position, say let's take an example where I'm going to sell a call option that expires at the end of July for 40,000 at a strike price of 40,000. Well, basically what happens, what you're saying there is that, okay, well, if Bitcoin remains below 40,000, then obviously you just earn the premium. There's no other issues or anything. But then if Bitcoin does go above 40,000, well, that's where basically your upside gets capped at the 40,000 level. And so basically, like there's the risk. The risk there is that you're capping the upside at a predetermined point. And so, it's like with Bitcoin, there's the thing to remember is that there's no guaranteed yield on Bitcoin, right? That's the thing that was sketchy with BlockFi and with Celsius, because you can't earn a return on your Bitcoin without taking some risk, right? In Bitcoin, there's no risk-free rate. There's no lender of last resort, and if a Bitcoin bank does screw up, right? That's why I think centralized Bitcoin banks, they're worse than even TradFi in some ways, because at least when Silicon Valley Bank screwed up, there was still a backstop, right? There was the U.S. government came in, they were like, hey, don't worry, we're going to protect your funds. In Bitcoin, there's no such thing. There's no such thing if a custodian screws up or a lending company screws up, and so basically like. When it comes to earning a return, it's always a question, okay, is the return worth the risk, right? And I think it depends on the answer to that question depends on the person. And there's always going to be a spectrum of folks who are, hey, I'm going to HODL only, everything in cold storage, not going to touch it for like 50 years. And then there's folks who are, more interested in, putting a portion of their stack to work and earning a return on that. I think there will always be people at different ends of the spectrum. The key is having that optionality, having the choice to be able to do these financial tools and use them and earn a return in a transparent, self-sovereign, verifiable way. And kind of like the thing that we've seen is that, hey, users come in, they're like, oh, yeah, I don't know, maybe I'll start with like, the smallest possible amount, 0.01, and then basically they slowly kind of make their way down the risk curve, down the spectrum over time. And as they get more confident, understand what's going on with DLCs and, all that kind of stuff. So yeah, it's an interesting question, but there's no risk-free rate in Bitcoin. You're always taking some amount of risk to earn a return.
Yeah, and it's important to be straight up with that in the beginning. Like you mentioned, the BlockFi and Celsius of the world. I mean, I'm pretty sure there's a pretty popular clip of Alex Mashinsky sitting down with Tone Vays and Safe.
Yeah.
Saying, no, it's a guaranteed 8% return, and Safe and Tone are like, you literally cannot guarantee that. Like, it's
100%.
But
anytime anyone's mentioning guaranteed yield on Bitcoin, run away.
Well, that could another thing too. I mean, obviously, there's an oracle necessary to basically provide a hash to determine what's going on at the completion of the DLC. What are you guys using for an oracle, or are you leveraging? I mean, that's probably another thing we should touch on. The way DLCs have been designed, you can leverage multiple oracles to make sure that there's some redundancy there in terms of the data that's being served to the contract.
Yeah, that's a great question. Well, and oracles are really the kind of the failure point of DLCs, right? Like, if you want to have any type of financial contract on Bitcoin, you need some type of external data. So the way our contracts are set up right now is we've got an external market maker that takes care of the other side of the contract. So anytime a user takes a cover call position, the market maker is taking the other side of that, and then we currently run the oracle. But we're planning to transition to multi-oracle in the future. And what that can look like, there's a couple different options of what you can have for multi-oracle in DLCs. You can have, say like a 2 of 3 model or a 3 of 5 model, where essentially, you need to have at least, 2 of the oracles that agree, or at least 3 of the oracles that agree on the price point. And as long as that is the case, you'll be able to go and execute the DLC and retrieve your funds, directly from it. And so that can really reduce that, central, point of failure in the long term. And so that's something we're definitely excited to move towards in the future.
Yeah, no, it's really exciting when you begin to add multi-oracles in the mix, because that's one thing. What was the project on Ethereum that really ran with like prediction markets? I forget. I think Augur. Augur was, they were marketing that they had solved the oracle problem, but I've become pretty convinced over the years of observing all of this is that the oracle problem is something that can never really be fixed. I believe Chainlink is trying to say that they've solved that problem too. The most that you can do is just mitigate the risk by eliminating single points of failure by leveraging one oracle and creating that multi-oracle setup that you just described, Matthew.
Yeah, well, and I think the other thing too is that anyone who's claiming to have solved the oracle problem, or hey, we've built decentralized oracles, the more likely thing is you've just distributed it to a bunch of different parties, and you don't know whether those parties are the same person, right? And so, in general, simple is better, just like multisig, right? Simple is better. It's not better to put your Bitcoin into a 900 of 99 out of 999 signers, right? It's better to have maybe a 2 of 3 that's simple. Same thing, with something like DLCs. It's better to have, something simple where exactly what the risk is and who are the parties that you're trusting, versus having something that's overcomplicated and really just being custody plus extra steps. Yeah.
So this gets to the question that's been lingering in my mind. I mean, I've been fascinated by DLCs for many years, written many bents on the subject, recorded many podcasts on DLCs, and I'm just curious from your perspective, what is the current state of discrete log contracts and what may be on the horizon that would make them better, more efficient, more reliable? Because I know, what was it, Digital Garage or Crypto Garage out of Japan came out with DLCs over Lightning using extension signatures. What, in your mind, are you guys excited about right now, or what's currently been improved within the DLC landscape since we last spoke?
Yeah, I think the main kind of innovation that's been going on lately with DLCs is really, first based, just more implementation around multi-oracle. But the other one is moving DLCs to Lightning. And so there's been some developments in the space around that. You can actually, we currently do DLCs on Unchained, but it is possible to move DLCs over to Lightning in a manner where you actually have a Lightning channel, and it can be used both for DLCs as well as for Lightning payments. And so that's really cool, because what you can do is you can convert a wallet that is just focused on DLCs to actually a Lightning wallet, and allow for payments to be done with it, in addition to actually entering into these type of financial contracts. And so that's definitely something that we're planning to transition to down the road, probably late this year or early next year, is move towards a Lightning wallet. And once you've got something like a Lightning wallet, you can do really interesting things. One of those is something called stable sats that allows for essentially you to be exposed to the stable, like basically it's like you're holding USD. And you basically just do a 1x short, you just short Bitcoin. And so you could imagine this being used in the Lightning wallet to allow for folks to, hey, say Marty, I want to send you, $10, right? And let's say in a alternate universe, you're not a Bitcoin maximalist. You don't even know about Bitcoin. Well, I could send you $10 of USD, right? In essence, and I could send that over the Lightning network, and on your phone you could go and enter into stable sats, basically, which is just the stable value of Bitcoin. And that becomes really interesting for being able to onboard merchants, of course. So that's going to be really exciting. And there's more applications being built on Bitcoin and DLCs too. Bitcoin-backed loans being done by Lava. 10-10-1 Finance is working on futures contracts. So the ecosystem is slowly but surely being built out.
Yeah, I think stable sats. I think there's going to be many ways to solve it. Obviously, before we hit record, we were talking about Galoy and what they're doing with Blink Wallet to bring stable sats there. They leverage OKX to create that stable value. So there's an external third party involved. I was mentioning that I recorded with Cody Lowe from Fedi yesterday, and they were talking about the stability pool. He was talking about the stability pool module that they're going to be rolling out, which allows you to do exactly what you just described within a Fedi mint, within a Chaumian mint. But I completely agree. Once that problem's solved, and there may be multiple solutions to that problem that people get to choose from depending on their particular risk profile or comfortability with each solution, that once they hit the market, it's going to be a massive benefit for the ecosystem at large. Because like you mentioned, there's a lot of people who really don't care about Bitcoin and cannot stomach the volatility that comes with it, but would gladly use it as a payments rail if they were able to get stable value at the end of the day.
Yeah, absolutely. Well, and imagine if the process, like for say a merchant using something like stable sats, imagine if the process of buying Bitcoin was just closing a DLC, right? And so you basically get a way to be able to easily convert, the cash that you've received, which is really stable sats, and then just convert that into Bitcoin at basically, no cost other than if you're on-chain network fees, or if you're on Lightning, the cost of a couple millisatoshis, which is really cool.
Yeah, and diving deeper into using DLCs on Lightning, like, is the latest cutting edge that extension signature workaround that Crypto Garage came up with about a year ago?
Yeah, so one of the guys at Crypto Garage, Thibaut, he's been doing some really great work on essentially implementing what's called DLC channels. And it uses that signature workaround. And essentially what it enables is he's building that ecosystem out in Rust DLC, right? And we've heard there's quite a big ecosystem being built in Rust. We've got Bitcoin Development Kit, BDK, Lightning Development Kit, LDK, and now Rust DLC. And I think what's going to be really cool that we're going to see in the next little while is more and more applications being able to be built on top of that foundation. So Rust DLC allows for both on-chain DLCs as well as DLC channels, which is really just DLCs on Lightning. And so I think we're going to see a really nice ecosystem being built out there in the future.
Yeah, but from what I understand, it's a workaround as you described it, right? Like, it's not like the ideal way to build DLCs on Lightning. Or am I wrong in assuming that?
I believe that's the correct for Rust DLC, but I know that 10-10-1 Finance built on top of that, where essentially what they did, not to go too technical in the weeds, is you can have both a DLC channel as well as a Lightning channel by using a parent commitment transaction. And so if you think about it, you have that parent commitment transaction that then can be split off into either a Lightning channel or a DLC channel, and then you can actually close it into the original Lightning channel. So that's what 10.10.1 Finance has done, but that's what was built on top of Rust DLC, but that's not in Rust DLC to my understanding right now. So I believe 10.10.1 Finance has implemented in a manner that is not a workaround, and that of course I expect to be coming to Rust DLC down the line. But that's something that we're planning to investigate more in the coming months.
Hell yeah. So what else beyond this passive strategy? How are you guys approaching product development for Atomic right now? What are your thoughts of ideas that you have on the horizon beyond transitioning to Lightning when possible that are getting you guys excited?
I think it comes back to, longer term, we want to be a one-stop shop. In the medium term, in terms of not just limiting ourselves to these passive strategies, being able to, offer maybe Bitcoin-backed lending or stable sats, as Matt mentioned. But in the shorter to medium term, I think there's tons of interesting kind of ways to offer additional strategies, whether that's, right now we have a covered call strategy, but could we offer a short put strategy moving forward? And that might align with some folks' market sentiment around being bullish on Bitcoin and whatnot. The reason we didn't start off with the short put strategy was because basically, Bitcoin has a tendency to, when it has a kind of COVID crash day, you're talking about going down 30, 40% in one day. And, if you're in a short put strategy, that's probably not a good day for you. And so kind of the tendency for Bitcoin to dump massively within a very short period of time is the reason why we kind of chose to start with, a cover call strategy. But beyond short puts, there's interesting ways to hedge price downside, with different types of strategies in a bull market. Say, hey, Bitcoin's now at 250K. It feels a little bit bubbly right now, and every one of my friends and their grandmas are asking me about Bitcoin. Well, maybe it might be some time to kind of, take some off the table, or and before all these kind of tools came about, the only ways to kind of take stuff off the table was to sell it. But there's some interesting potential ways with options and with DLCs to be able to actually hedge in more creative ways with things like collar strategies, where you're hedged below a certain price if Bitcoin's price falls and stuff like that. And so I think there's some really kind of interesting use cases for options and DLCs in the short to medium term that we're really excited to kind of start building out, especially in advance of the next major bull run. And I think the sky's the limit when it comes to all that kind of stuff. But longer term, I think definitely even things beyond the strategies themselves, like stable sats to what Matt was mentioning earlier.
Mm-hmm. And do you guys think with what you're building, with 10.10.01's building, really proving that you can do this type of sound finance on Bitcoin, do you think there will be a shift in sentiment in the broader market looking at crypto to have an aha moment, like, oh crap, maybe have the aha moment that you had in 2020, Tony, oh, we're doing it all wrong over here? Do you think it's getting to a state within the sound finance arena of Bitcoin where it can be more attractive than the DeFi yield farming that's going on over there?
I certainly hope so. One of the things when we did that pivot back in the day, it was, we could have stuck with ETH, launched a token. It would have been a lot easier to make a quick buck. But our whole thing was that, we don't want to do anything that compromises our what we see as Bitcoin's main value prop, which is stopping money printing and all this kind of stuff. We didn't want to do all that yield farming stuff. But the thing is, for a lot of folks in the wider crypto space, I think that the view on Bitcoin is that, oh yeah, Bitcoin, they might have Bitcoin, but Bitcoin is just kind of a pet rock. It's something that kind of folks buy and then just hodl and stow away for the rest of time. I think that like the way that I see kind of Bitcoin evolving over time is I kind of see it like electricity in a way. Like basically like, okay, electricity, light bulbs, that was the first killer use case. But after that, you know, there were vacuum cleaners, there were electric washers and stuff like that, right? With Bitcoin, I think the clear first killer value prop that we've really discovered as a community is that, hey, it's the best self-sovereign store of value out there, right? That's the first killer app. But you know, what's our version of electric fans and irons, right? Maybe it's going to become the unit of account that we spend in. Maybe it's the thing that we do commerce in and conduct finance with. And you know, our view on it is that there should be a finance component, right? We should be able to do you should be able to have a non-custodial infrastructure to enable more finance to be done natively on Bitcoin and do so like non-custodially, transparently. And so that's kind of our whole view on it, you know, longer term.
Yeah, and using that view to juxtapose, what are your, I know you guys have been out of that world for quite some time, but the view on the state of Ethereum since we've last spoke, Matthew, they made the transition to proof of stake. The staking environment is interesting insofar as like it's just fun to observe from afar what's going on there. It seems like there may be some centralization risk. What are you guys saying?
I think the biggest thing we've seen for the move to proof of stake, well, first of all, it took them long enough, and then once they actually did, you know, we all knew that what proof of stake was going to do was just going to move the power from the miners to the exchanges, and I think we've seen a situation where that has essentially occurred, where you've had a lot of centralization around Ethereum and a lot of concerns around that. And so I think like with something like Ethereum, you can have a lot of progress, but a lot of progress on the wrong things. And so I think there's this belief in Ethereum as well that proof of stake is going to solve scalability. But I don't necessarily think that's the case, because you have so much state on chain. You have such large blocks. You have so much information that is stored in the chain itself that, you know, over the long term, I think it's going to be almost impossible to scale. I think, Tony, you were mentioning that there was an issue with the Lido contract as well on Ethereum, right?
Yeah, I mean, like right now, one of the big discussions in the Ethereum community that I know about is that you know, Lido, which is this kind of large staking service that a lot of ETH bag holders are staking their ETH with. Well, that's basically now like taking up a very large portion of the ETH staking power. And basically there's lots of centralization. There's, you know, increasingly even Ethereum maxis are like kind of ringing the alarm bells and saying, hey, is this really good for Ethereum and stuff like that? And so, you know, but that's the kind of, that's like, you know, ETH is going to continue to trend towards centralization because they've turned it into this proof of stake and everyone's just incentivized to kind of stake with, you know, these large services where it's easy and it's convenient. And so basically, like, I don't see that issue really going away, and that creates like a large pressure point for, say, state or nation state kind of actors to, you know, potentially push ETH in a certain direction, one way or another.
Yeah, and isn't Lido marketed as like the decentralized staking validator? Isn't that the goal, is like get a bunch of individuals to put up their ETH, stake via Lido, and wave a wand, and it's somehow decentralized?
Essentially, yeah. But my understanding is, to be honest, I don't know that much about it, so I can't comment on it that much. But yeah, that's essentially what the point is. But like yeah, I yeah, kind of blank there for a moment.
It's all good. So what else haven't we touched on that we should bring up? Oh, we had the freaks engaged Because this is very exciting. I do agree that, like, in some capacity, we're going to need financial products on Bitcoin. And if they're going to be on Bitcoin, they should be leveraging the native properties and giving end users transparency and the ability to validate what's going on at any given point in time. But it's still like a scary proposition for people in the HODL mentality, which is like, hey, we're still in the early stages of the monetization process. Is it really worth it to engage with these types of products right now? Is there an order of operations to all this? And does this sound finance product fall on the back end of those operations?
Well, I think, Marty, I think it really comes down to, just looking at, what are the different layers that need to be built in Bitcoin in general, right? You've got self-custody, right? You've got people that are locking their, Bitcoin in their cold storage wallet. Then the next layer is maybe of payments on Lightning. But why is it to do anything related to finance? The next thing is going to an exchange, right? That just seems insane. And so if we want to avoid people being rugged by exchanges, then we need this, sound finance layer. I was chatting with a company recently, and here in Canada, and they were using BitMEX back in the day just for hedging, right? So people buying and selling Bitcoin, and they were just using it to hedge. That's all they were doing. And what happened was, obviously BitMEX ended up being banned in Canada, and then they went on and they ended up switching to using FTX. And of course, FTX blows up and they entirely lose a portion of their balance sheet. But honestly, that was really heartbreaking for me, because I was like, well, if we can't allow for companies to be able to hedge in a non-custodial manner, well, what's the point, right? And so to me, it was just like, wow, we really need to hurry up and allow for these folks to be able to do these type of things, because that's really what's missing here. But I think the other thing that's like really interesting about these layers is, we're getting DLCs on chain, we're getting DLCs on Lightning, but at the end of the day, where does this go? How do we scale this? Because there's not going to be enough space on chain for every, individual to have a UTXO, let alone a payment channel for Lightning. And so where does that leave DLCs? And so I feel like this, there's this ethos, right? We have this ethos around, non-custodial, and this ethos around self-custody, but, how does that scale over time? Which I think are some of the really big questions.
Yeah, completely agree. And I was at the Lightning Summit in Nashville last week, and the last panel with Tony from Mutiny, Lisa from Blockstream, and Base 58, and Alex from River. I think that's what they highlighted. And what's one thing I really appreciate about Bitcoiners is, yes, we have these grandiose ideas about where things are going and the possibilities that lay before us, but there's also, whether people want to recognize it or not, a lot of sober recognition of the limits that we have as we're trying to do all this. And one thing that's becoming abundantly clear with Lightning is that it has limits itself. It's not going to be the only solution that onboards the world to Bitcoin. And that's why I was really excited to have that conversation with Cody from Fedi yesterday. And the way he prefaced Lightning was sort of the IP layer of the second layer on top of Bitcoin's protocol, where you'll have many complementary second layers like Fedimint, Lightning, Liquid, and you'll basically be able to interconnect them using the Lightning network. And I think what Fedimint, the open source project, and what Fedi, the company, are doing to create a scaling solution within these Xiaomi mints is really creative. And one thing we should really be focusing in on and doing more research around is like, all right, how do we create scaling solutions on the second layer beyond Lightning that really make it so you don't have to touch the chain as much as possible to either move Bitcoin or open up channels.
Yeah, well, and I think this brings up really interesting questions about, scaling long term. We just saw, a couple months ago, Lightning completely broke, um, based on on-chain fees going up substantially. And so then what are the solutions? Well, we have solutions like Fedimint that exists, but there's some considerations around, how are the funds in Fedimint or in the mint being secured, right? Is there a potential for a fractional reserve Bitcoin to emerge from that? Then we see, large discussions around things like ARC, which might allow for, this is oversimplification maybe, but like a non-custodial version of Fedimint, but with very high capital requirements for the business running ARC. So I think this brings up a whole notion of questions around how is Bitcoin going to scale long term, and are we going to end up in a system where like the majority of Bitcoin is eCash, or are we going to end up in a system where we still have non-custodial solutions, but that non-custodial is just at an upper layer? And then can we then, after we do that, can we build financial tools on top of that? But I don't know. I think we have to be really careful to not end up with systems that we think are safe, but end up being rugged in the long term. Yeah.
Yeah. It's a bit unnerving, but also exciting too, because there's so much to explore, so many ideas to test out. And again, I think that's one thing that I appreciated toward the end of the Lightning Summit, and something I think everybody should internalize is, hey, like we're not exactly sure how this baby's going to scale at the end of the day. Like we're still figuring it out on the go. There's no panacea right now, but what gives me confidence is that there's an incredible number of smart individuals like yourselves really focusing on these problems to make sure that it does scale. And if Bitcoin's history has taught us anything, it's that we'll hit these limits, these scaling limits, and say, all right, here's where we need to improve. And then people go back to the drawing board and say, all right, let's try this out.
Yeah, absolutely. Well, I think that you bring up a really interesting point there, which is around, I think that's what we hope, right? We hope that when we hit these limits, there will be, there's smart people working on solutions that will allow for Bitcoin to scale without compromising on our ethos too much, right? Like one of the big ethos for Bitcoin is self-custody, right? But does self-custody scale from both from a social perspective? Are people willing to self-custody? But also, does it scale from a technical perspective? And the thing is, the default for this is failure, essentially, right? Like the default for this is that Bitcoin scales by largest institutions custodying it, and us ending up with a situation where a state actor can end up rugging a large number of people. And so I think, and so then this brings into an interesting question around, ossification, right? There's a new group of people that believe that just Bitcoin should not change, ossification maximalists. But the situation is, if that is true, if Bitcoin does not change, then that dark future of Bitcoin just being custodied by institutions is the default. And so I agree with you, Marty. I think there are a lot of people working on scaling solutions, incredibly smart people. But I guess the hope is that we don't ossify Bitcoin too early, right? Like I'm not saying change Bitcoin like crazy. Absolutely not. That's Ethereum, right? We don't want to go into that. But if we can make some small changes, then maybe that just allows us to avoid that default outcome. I don't know. What are your thoughts, Marty?
I agree. I mean, I think ossification at some point could be advantageous. And I do think the term ossification is not really descriptive of what is needed, because there's always going to need to be maintenance. We know we need at least one hard fork because of the Unix timestamp bug. And I do think, like, if we're being honest, you probably want to leave the ability to change Bitcoin open in case there's some unforeseen unknown that we encounter in the future that essentially forces us to fix something on the go. But I do agree, like, we shouldn't be Ethereum. We shouldn't be changing just to change. But yeah, if we do any more soft forks or hard forks in the future. We'll have to do at least one, reminding everybody out there. It's gonna, I mean, and that's the weird part about distributed consensus too. It's like, even if we wanted to, will we be able to? But these conversations have to be approached extremely seriously, and there's got to be a lot of open discussion around it, obviously.
Yeah, it's a question of how do you do governance on a distributed protocol, right? And it was funny, Marty. I was talking to I was trying to orange pill some. I went back to my old high school and I was trying to orange pill some kids there, and one of these kids in grade 12 came up to me and she asked me, "Oh, well, how do you make changes to Bitcoin if no one controls it?" And I was like, "Well, you just asked the question that we're like all of us have been trying to figure out for 14 years." So there you go.
Yeah. Well, on that note too, are there any sort of changes that are being talked about right now that could potentially be merged into Bitcoin that you guys are excited for, would be willing to back with your reputation?
Oh, geez, Marty. Well, if you back anything and then it goes sideways, but I think in general there's a couple interesting ones. Like obviously, the biggest ones that come to mind for me are really APO and CTV. Obviously, I think there is this viewpoint and for those that don't know, APO is any prev out, so it's just a small change to Bitcoin that allows for you to commit to changes in the future. So it would allow for a better version of Lightning Network without the penalty. So obviously something like APO I think is interesting, but then we originally thought that APO would enable a scaling solution like Arc, and then we realized, the founder realized, actually that's not going to work. We need APO plus something else. The one that's really interesting to me, and I've been following for some time, is CTV, because CTV not only would enable for interesting like scaling capabilities in Bitcoin, but also has cool applications for DLCs too. You could have right now, if you want to enter into a DLC, we basically have to have the user have some type of hot wallet, like say on their phone or on their desktop or something of this nature, because there's so many signatures that need to be created. If you imagine like a futures contract or an options contract, you need to create a signature for every single one of the possible outcomes. So imagine trying to use a hardware device. Imagine trying to use a cold card and clicking to go through each of those to create a signature. You'd be there all day creating 5,000 signatures. Whereas something like CTV could allow that to be done with one click, and could also reduce the time to enter a DLC from 1 or 2 minutes down to 2 or 3 seconds. So I think that one's really interesting. And I think it's really fascinating how the community was kind of initially opposed to CTV until more and more interesting applications started relying on it, and then now that restarts the discussion. So I'm not saying CTV is perfect or there are maybe some flaws with it, but I do think it enables some particular use cases that are really compelling.
Yeah, and if I recall correctly, too, the controversy around CTV's activation when it was being broached last year or the year before wasn't necessarily about what it would add to the protocol. It was the mechanism that essentially allowed it to get merged into Bitcoin. So the consensus mechanism of speedy trial, I believe, is what they ran with. And we just did speedy trial with Taproot, and a lot of people are not happy with how that went. And so I think, again, talking about the concept of ossification, I think the biggest hurdles to getting something like APO or CTV moving forward will be coming to consensus about the activation mechanism that actually gets it into the code base.
Well, when I find it funny for something like Taproot too, something that was very uncontroversial at the time, it wasn't that people couldn't agree on what changes should be made, but how to activate those changes. And that seemed, and I don't think we've come any closer to coming to a consensus on what the activation method should be. And so I think there's a likelihood for that, there to be kind of two sides of the equation, like BIP8 or BIP9, like for speedy trial versus the others of, what's going to be activated. But I think that actually brings up an interesting thing as well, Marty, which is, now there's new people coming out there that are like, hey, Taproot and SegWit were a mistake because they enabled ordinals, which I think is pretty wild, because if you just looked at each of them individually, you would never expect something like ordinals to come from them. But then the addition of SegWit, like the discount, plus Taproot increasing the script size, enabled something like ordinals, and so that just put fuel on the fire for the ossification maximalists that are now like, well, should we not change Bitcoin? It's just crazy.
Yeah, and then you add in the fact that Bitcoin adoption is growing, and so more people are joining the network, and then you just have a bigger coordination problem as that happens. So that's the other thing I think about when it comes to upgrading Bitcoin in the future. Like, obviously, we believe that others like ourselves or other people who have not grokked Bitcoin to date will begin to grok it and therefore adopt it, and there will be more full nodes added to the network and more stakeholders within the distributed consensus, and that makes it even harder to change. And it's really a mind fuck when you begin to fall down the rabbit hole of all the nuances that go into that stuff.
Yeah,
well,
I feel you, Marty.
That's why media. Sorry, that's why content creators like yourself, Marty, are so essential to our ecosystem, right? Like community, like bringing in, experts, talking about what's happening, and like educating the folks, the freaks. That's what it's all about.
Well, that's a good point too, and it's scary too. Like Matthew, like you mentioned, like the combination of SegWit and Taproot created these unforeseen abilities, and I was a big advocate of SegWit and Taproot, and I am not technically competent enough to actually audit the code and think deeply about the interactions of those two different upgrades. And looking back in retrospect, like I was a big cheerleader of Taproot. We talked about it on Rabbit Hole Recap week in and week out leading up to the activation, and we put our thoughts out there. And looking back, I'm like, God, maybe I think moving forward, I will definitely be more calculated in the way I quote unquote cheerlead for upgrades, and be more upfront with like, hey, I actually don't understand the math or the code that makes this stuff. I mean, I understand parts of it, but in terms of like thinking about complex interactions of multiple changes, it's something that's above my pay grade.
Well, wait. So hold on, Marty. So you're a fan of SegWit and you're a fan of Taproot. Wait, you're an ordinals lover? No, I'm just kidding. It's crazy though, right? Because the other thing too is that there's a very small number of people that can actually audit all the code, right? So you might say, oh, I can't audit the code myself. But even like most Lightning developers, right, that are actively building with Bitcoin, that have a technical understanding of Bitcoin, don't understand all parts of core, all parts of the underlying protocol of Bitcoin. And so there's such a small number of people that can see. And then the other thing is trying to think of these edge cases ahead of time is almost impossible. For a change upon a change that could lead to this outcome. Like nobody foresaw ordinals before we got to this point, and so it's a hard problem, and I don't know. I guess it just requires more education and people talking about it, people being creative, I guess, and coming up with ideas and what's possible if you do this change, or what's possible if you do that change. If we have more creativity and ideas, before we merge it, then maybe we have a better idea of that, but it's hard.
Yeah. I mean, you mentioned Barack in ARC earlier, but he's the one who broke Lightning Network twice via Taproot. Maybe that's what we need, is just more robust testing environments before something gets merged, and then sending people like Barack in to do weird things like create a 998 of 999 multisig to see what breaks on top of that.
Yeah, but I think even that's hard too, because most people don't pay attention until there's money on the line, right? You could have the most elaborate scaling solution, or elaborate, well-tested, new soft fork for Bitcoin on on SigNet or on testnet, and people could be, testing it out but at the end of the day, people aren't really going to pay attention to that until there's money on the line. And I think that's what makes it so hard is the testing process. And so I guess we just need people earlier on in the stages of development to look at those things, and maybe more money going to earlier stages of development. I don't know.
Yeah. Again, big problems. It's unnerving, but also exciting. Is on the cutting edge of all of this stuff. But I mean, a lot is at stake. Like, I mean, we have it on the agenda to talk about the inflation numbers up in Canada. And I mean, they're coming in low, but I think you two would argue that they're being severely underreported. And I would agree. I would say I think that's happening here in the US to an extent too. If you've been to a grocery store in the last couple of months, and that's, the weird balance that we face as people building out this network and the layers above it is we deeply believe, I intuitively believe that it's essential for freedom in the digital age and providing humanity with a monetary good that will preserve value and respect people's savings. But it's also like, it is a software project, an open source software project, bringing a distributed system to the world that's very hard to maintain. And again, people don't like to talk about the boogeyman scenario of getting down the line and being like, oh shit, this actually doesn't work. But we've got to have these conversations,
Yeah, well, I think it's like with something like Bitcoin, it's like it's like we only have one shot at this, right? We've got one shot to make the most the most impactful and foundational money for humanity, and there's going to be millions, billions, trillions of humans in the future that could be relying on what we're doing today, right? Like, no, because like if humanity expands, right? If the agenda for depopulation doesn't happen, then then we'll be able to, then we'll have that many people. So that many people are dependent on us doing it right. So we got to get that right. You were talking about Canada, Marty. Like, yeah, I mean, it's crazy for us up in Canada here because there's talks of, we just had COVID tyranny for 3 years, and then the talk of CBDCs, and they like to lie to us about the inflation rate, and so. Geez, you guys down in Texas are it's looking better and better every day.
Yeah. So what are you guys seeing on the ground? I mean, what was the inflation print?
2.8%. Yeah. And anyone who's been living in any of the big cities here, I think would strongly disagree with that. I actually like dug into it a little bit. It was like, they were saying like, like the reason why inflation rate has come down is because your cell phone bill got cheaper and this got cheaper. But I was like, I don't know if anyone's cell phone bills in my circles that got cheaper. But I think the way that they're doing it is just saying that, hey, like, you're getting more data for the same price, or and that kind of stuff. And that's the way that they're justifying, a decrease in pricing, and that it's just manipulated out the wazoo. It's just like when it comes to CPI, it's probably the most manipulated thing there is from the government.
Yeah, it's almost like a humiliation ritual. It's like, don't believe your lying eyes. It's 2.8%.
Yeah, and we've got a leader that's obviously in bed, with the WEF. It's the young global leader. So we're hoping for maybe Poilievre to get in here. He's the potential, the pro Bitcoin guy. Although he went out there and he promoted Bitcoin, and then the other side of the aisle's been after him for saying that for the past 2 years. So we'll see what happens.
It's also tiresome, gentlemen. It's also tiresome. Mm-hmm. I mean, we have RFK pumping Bitcoin, trying to restructure treasury bonds by embedding Bitcoin into them, which is an exciting proposition by a potential president. But again, I'm not holding out hope that the politicians are going to solve this.
Well, I'm excited that there is at least a politician that is in the process of being orange pilled. I think that's very bullish. I think what did he tweet today? He was saying, hey, I would have the US dollar partially backed by Bitcoin. I think, maybe that's a good stepping stone, right? But the reality is if you just have the dollar backed by Bitcoin, it's not convertible, then you just run into the potential for the same fractional reserve system we have today in the long term. But if that's his stepping stone for becoming orange pilled, then maybe that's a good thing. I don't know.
Yeah. I'll take as many orange pilled politicians as we can get. Again, don't want to depend on them, but if they're pumping Bitcoin and making it more palatable for individuals who have historically been under the persuasion that it's some sort of Ponzi scheme, that's, I think, a net benefit overall.
Yeah, absolutely. Well, we just need more folks like that they're pushing for freedom, pushing for being able to hold your own coins, pushing for making sure that a 6102 doesn't happen ever. You guys, I'm pretty impressed actually in the United States and what you guys are. You have two senators that are pro Bitcoin. You have RFK, people on both sides of the aisle that are pro Bitcoin. Canada has a lot of catching up to do, I think, in that regard.
Don't worry, we'll come save you guys up in Canada one day. We'll annex the good parts of Canada to the US when the time is right.
We're looking forward to it, Marty. We'll be America's hat, There you go.
Hey, I mean, if you guys get rid of capital gains tax on Bitcoin, we'll move down there ourselves,
Hey, Texas is open. You just have to come to the southern border illegally.
Fair enough. Oh man.
Gentlemen, this has been a great conversation. I'm excited for you guys. It was great to catch up in person in Miami. And I think you guys are working on one of the most interesting parts of Bitcoin and underscored parts of Bitcoin, which is DLCs again. I've been very excited about DLCs for many years. And to see you guys building products that actually leverage the technology is extremely exciting. And it works. I've used it.
Yeah, no. And it's not easy. It's not easy, building on Bitcoin, doing things non-custodially. It's not an easy thing to do, but we're excited more than ever to kind of keep focusing on Bitcoin, to keep building out non-custodial financial tools for folks, and really enable kind of a financial layer, non-custodial, sound financial layer to be built on sound money. And so, excited for lots to come.
Where can the freaks find out more about you two, Atomic, what you guys are building? How can they help?
Yeah, absolutely. Check us out on atomic.finance. That's our URL. I always encourage folks to kind of start by learning with like a very, very small portion of their stack that they feel comfortable using and learning with. It can be as small as 0.1%, 1%, see how you feel, it's enough to kind of give you incentive to dig deeper into the tech, learn what DLCs are, what's happening here, and, take a step further into being a true Bitcoin native participating in the wider Bitcoin economy, right? Whether you have options experience or not, doesn't matter, right? Because we built it to be ridiculously simple to start with, and you just need 0.01 BTC to get started. So that might just be one DCA. See if you like it, right? And that's how a lot of us got started in Bitcoin anyway, right? Just by trying it out with a small amount. Would love to kind of see freaks out there on atomic.finance and checking out the app. In terms of on Twitter, we're trying to tweet more now. Me personally, I'm on Tony Kai _. Matt's Matthew J. Black, and our company Twitter account is @AtomicFinance.
Awesome. We're going to link to all that in the show notes. Matthew, anything to end it on here? You're muted.
Thank you. I was just going to say, I think, Marty, it's time for people to stop getting rugged. It's time for us to build the layers that Bitcoin needs. It's time for us to, believe in self-custody, self-sovereignty. So I don't know. I'm just excited to build it, and I hope the people from Ethereum that are building nonsense right now, they realize what's important, and we get more of them over in Bitcoin and building sound finance for sound money. Yeah.
Building sound finance for sound money. That's a good bite. It's a good bite, gentlemen. I like that. It's a good sound bite.
Thanks, Marty.
Sound finance for sound money is a good sound bite.
Yeah, we can't call it DeFi. DeFi is too tainted. You want sound infrastructure for Bitcoin. You need sound infrastructure that creates sound finance for sound money. That's we're not building nonsense anymore.
Well, you heard it here first, freaks, or maybe you heard it on another podcast or on Twitter. But sound finance for sound money. Matthew and Tony, thank you guys for coming on. It's always a pleasure. And who knows when I'll see you next in person, but can't wait for that day.
Absolutely. Thanks for having us, Marty.
Peace and love, freaks.